Hello traders, welcome to FreeFX. Today is Friday the 16th of September. I have a great video for you today. I'm not feeling great actually, so sorry if I sound a little bit choked, but I just still wanted to make this video because it's been a really interesting week and there's a lot of stuff happening next week, so I kind of wanted to go over that. It's also been a very good trading week for me personally, so I'm very happy with things. I just kind of wanted to share that kind of optimism. And the other thing is that there's a lot to say about the week ahead, and so in preparation for that, it's important to have an idea of where we're going based on last week, but also wider trends. So I'm going to go straight into that, and I'd like to thank everybody for your support. This is video 130, and when I started this channel I never thought I'll get this far, so it's been a journey, shall we say, but I'm very happy with the way things are going. So again, thanks for watching. So today we're going to talk about the S&P 500 SPX, which I trade as a CFD through Oanda. So this is where we are at the moment. Now I've got two charts. I kind of prepared them in a way that reminds us of how things are. In a way, history doesn't repeat, and it rhymes, as they say, but I think it's quite important to also recognize that there are similarities that we should be aware of. And this idea came looking at the channel on Twitter by Michael Kramer, and he is the founder of MOTT, M-O-T-T Capital, and he has put in a number of videos and also a number of graphs, and some really interesting ones looking at historical precedents and also looking at how we have similar situations happening, not just sort of in the graphs for stocks, etc., but also like this one here for the VIX 2022 versus 2008. And you can see in the two colors, we've got the one in blue obviously is 2008, and then 2022 is where we are now. So as you know, the VIX is still fairly muted. We're in the 20s now, and so it's not at the levels that we've seen here when we go into the sort of 70s and 80 mark, but that seems to be where we're heading to in the latter part of the year. But the one I really want to show you was the one where there's a comparison between 2008 and 2022, which is this one, which Michael has been updating regularly, and so I wanted to share that with you just to make it a bit easy to see. I'm just going to make this full screen. Now, the white is the 2022 current, and the yellow obviously is the historical one. You can see that he sort of juxtaposed them, so you have exactly the same date. It's not really hard to see that there are similarities. This middle area here sort of is, end of 2021, beginning of 22 is kind of where we're at in terms of the two starting to really sync properly. And we've had the so-called bear market rally here in sort of mid-July to mid-August, which really resembles the one from 2008. And we'll talk about that in a second. And so I'm going to close this, and thanks to Michael Kramer for posting this, and I'm going to go back to minimizing this and on to the two. So the first one on the top there you can see is the 2022 obviously, and we are coming to a pivotal week because not only was today or end this week the options expiry, so-called witching or quadruple witching, which always makes me think of Henry Cavill and the Witcher series, Geralt of Rivia. But it's not. It's all the name kind of is inspired by the sort of something magical and something of the occult. But actually, it's not as interesting as that. It's really during the expiry of these stock options, futures, etc. These are different categories of options. And futures, you have more volatility, or rather more volume, not necessarily more volatility, but you have more volume. So this can generate some moves in the market, although they say that more recently this has been better managed in terms of price, so it's not such a shock to the system. What happened to the S&P this week is, as you can see, we had a steady decline. We'll break it down into daily and then sort of 4 hourly and hourly as well, just to show you. But certainly it's been a declining week. And as I showed you before, we've been against the 4100 for some time, for the last 4 months. But finally we're coming to basically coming away from that level, and we're coming to lower numbers. But what's really significant is that we've had a great comparison starts to emerge, as I said, with the 2008 prices. So here's the January, just where I'm pointing. We're about week of the 10th of January 2022, and below that you'll see the week of the 14th of January or 7th of January 2008. So we start seeing a descent. And then we have essentially this rally. What's significant is that obviously it might look slightly different, but it's very close in terms of price action. So if I just make that a little bit, okay. So there's the rally, and essentially if we go from here to the top. It was about 12%, let's say, an estimate there, 12%. The rally we had later in the year, this year, gave us about 18% gain. So sort of not too dissimilar. I mean, different, but similar. And in terms of span, this one went from middle of March to middle of May, so 2 months. And this one lasted 1 month, so slightly more aggressive, but similar in kind of scope in a way. Having said that, what happens next is that this is where we're at September and September 2008. So what happens next in the tail is that we have this big candle in 2008 and another big sort of weekly candle. So there's a big decline coming up, and that takes us to the start of October 2008. So in a way, we are going to explore that. If you wanted to kind of measure that, those 2 weeks combined, more or less, will give us about, let's see, to the low or the close. Let's go to the close, 27% decline, more or less. So 27% decline would, in the next sort of 2 weeks, let me show I can actually do that. I have to squeeze this a little bit. Would take us to, let's do it from here. 27%, doesn't even fit. Just maximize that. 27% would take us to, it doesn't fit. Still have to squeeze it a little bit more. 27%. Okay, that would take us all the way down here to 37, sorry, 37.90, roughly 37.90. Okay. Now, I think that's sorry, 27.90. 27.90. My prediction is that we're gonna get to 37.50. Very, very sort of recently, I said it was gonna be a possible target, but this would take us much lower than that. Okay, so we'll be below 3,000, and if you sort of put it into perspective, 3,000, let's put a little marker there, and it would be 3,000. Now this is obviously not going necessarily to pan out this way, but if I just put a coordinate 3,000. Okay, so it would take us below 3,000, and we haven't been below 3,000 since basically just that's kind of resistance there in 2019, July 2019. So basically 3 years. The pandemic took us above and then below and back to it. But essentially, it would take us below the levels of 3 years ago, 3 and a bit years ago, before a sort of whole pandemic, obviously. And that's quite significant because that level, if you see We had the 2018 crisis. We were close to that level, and they took a whole other from January 19, basically, or December 18, all the way to May of 19. So it took all that time, basically half of 2019, and then further still to July. So it took basically half a year to get back to that from September 18. So almost a year basically in this kind of cycle of 2018. So that's kind of where we could be heading if we made this a comparison to 2008. And I thought that was interesting, thinking about the scale of what is called a bear market, but it's really just a downtrend, a natural downtrend, which should occur in a market of any type, whether it's stocks, futures of any kind, or indices, ETFs, forex. There needs to be some kind of rebalancing at some point. And although people complain because long only investors or people that just like to be long only generally have that sort of view of the market, it's not really realistic that something should climb for 10 years, never actually change that outlook. And the pandemic crash wasn't really, it was a rinse and return. So we're talking about something more systemic, and this is what we're seeing. And I think that gives that more room to continue lower, which is why we're talking about this. Now, this is where it gets interesting, because cyclically speaking, I put a poll out saying that in the week of the non-farm payrolls, we get down to 38.30, and we got very close today because we're at 38.35 was the low of today. So if you look at the low this week, as you can see, 3835.8, that was today. So why is this important? Because my next target is actually 37.50, and that's very achievable, as I just demonstrated there. We could be heading to as low as below 3,000, but let's kind of not worry about that too much, because cyclically speaking, that was non-farm payroll week at the start of September. It's been 9 trading days because the US had the extra holiday on Labor Day. So if you take all those holidays, weekends, and 9 trading days, we got to basically 38.30. So it's the pace is there. We're getting lower, and next week, obviously, the big catalyst is the FOMC. Federal Reserve is meeting. The 2-day meeting, Tuesday and Wednesday. We have the 20th and the 21st. The Fed funds futures are looking at a Fed rate hike of 75 basis points. And let's look at the FedWatch Tool on CME. There's your countdown, 4 days, 17 hours, etc. And there was a problem loading content. I'm going to just reload that and see what happens. So on this, we have the probabilities for different rate hikes. As you've known this for a while, I've been showing this on and off throughout my many videos. The 50 basis points that I showed in one of my last videos for September was there. Now it's kind of vanished. It's vanished because pretty much the highest probability has been taken over by the 75 basis points hike, or 0.75%. It's now priced in at 82%. But what's interesting is that what we had before was the 50 basis points, and then we had the 75 basis points. Now we also have, appearing on the right corner, weighing 18%, is the 100 basis points. So the 100 basis points is actually emerged as a possible contender in its boxing ring. But it makes me wonder, because at 18%, it's not a very strong contender. But what's really caused this change of heart, or change of probability, in my view, is what the CPI, so the core inflation figures that came out on Tuesday. I think that's what's caused this change. The media blackout for the Fed this week did not allow for any response to the CPI figures. but that per se, the data was enough to get people worried, if you like, about the Fed hiking to an even greater degree, front-loading to 100 basis points. So that's why we have the emergence of this, which wasn't there before this week, indeed before Tuesday. So it would be interesting if you wanted to look at the November. You have the three scenarios, obviously, and so from 300, which would be where we get if we got 75 basis points on this meeting, from 300 we would be to 375, so the middle column would be the 75 basis points, and it's priced in at 54%, so it's the strongest. And then you have the 50 on this side and the 100 also appearing in November at 10%. So forward looking, we have these kind of probabilities. December, it's like this. In December we've got 4 scenarios actually, which is interesting because that would give us this. So 375 would be with a 75 basis points. From 375 to 400 would be a 25 basis points. To 425 would be a 50, and so for the December, they're actually seeing the strongest case for a 25 basis points, and no hike would be 11%. No hike, 50. Sorry, no hike, 25, 50, and 75. So the 25 is the strongest case for ending the year with the last rate hike of 25 basis points. That's how FedWatch Tool, based on probabilities, is seeing the scenarios. Let's go back to my other tabs, because I wanted to show you the CPI. So what happened is the CPI came hotter than expected this week. I'm not going to go through the calendar. Trust me, you can find that data everywhere you look. So I'm going to go to the daily and just kind of show you that briefly. So here's the daily, and I'm going to put my indicators back on, and also the other ones. Should be able to find them. It's either here, yeah, 1 and 2. All right, so here's the situation is that the CPI came in quite hot on Tuesday. I did mention incidentally that again, I think it was, yes, Michael Kramer again, Cleveland Fed, and I mentioned this on Monday, tends to be quite accurate with its predictions for CPI, and I did say it was going to be 8.3, and we're right. So here's the Tuesday candle. As you can see, it's pretty hot. It came at a high of 4158 and a low of 3918. Okay, so it's for it's 240 points, 240 points on the day. Pretty big move by any standard. You could go back and see, but it's comparably quite a strong candle. Another big candle was here on the 26th of August, but this was pretty strong move. And what's really interesting about it was that, and I'm going to go back to my CCI, one of my favorite sort of indicators, is that I was saying on Monday that we were just coming up to the 0 level, and then that sort of took us all the way down through Tuesday to pretty much negative 200, more or less. And that means that it gave us a strong case for continuation to a downtrend. And indeed, then we sort of, that's your, sorry, not here, down here. So to 0 and then down. And this is going to take us to minus 200 eventually. So, and as I said before, there aren't many cases of this exact getting to 0. Sometimes we go short of it, like here when we're downtrending, we're kind of short of it and down. So minus 50, 60, but we got right to the middle line, and that was a perfect technical setup. And on the actual chart, you can see that we had the price coming to the basis and then going slightly above and then coming back down. So perfect technicals, perfect storm with the CPI numbers coming hotter than expected, raising the possibility of expectations for 100 basis points rate hike next week from the Fed. So all that considered, great technically. Took some shorts off. This one basically hit target or almost. Great stuff. Fantastic shorting there. Now, the ATR is above 70. We're into 80 now. We're at 82. So doing great in terms of that actualized volatility starting to rise. All the red lines, I've shown this in a previous video, in fact more than one. All these vertical lines are showing is the points where the ATR was basically at 70 or coming to 70 or bouncing back from 70 to a higher level. So the first one was October of last year. It sort of peaked 270 and then came back below for the continuation of that uptrend. Then we went higher, but the main point was this, where we sort of dipped below it, had this sort of double bottom, if you like, and then the middle of that is where the red line is just in January, and as it started picking up, big price move down from there. We came back 270, and there was a sort of this kind of rally, if you like, March to April, and then as it picked up again, we had this further move down to the June lows, and then this long decline, and then we came back to below 70 and started picking up again. So this is a pivotal moment because we are picking up from below 70. It was about 63 or something like that, so we've climbed a fair bit, and that's quite important as well. As well as that, we have obviously the VIX, which again, my target was not target, but my zone, if you like, my control zone, if you like, was 20, and now we've climbed up, and the VIX is sitting at 26.3. It's not as high as it could be. I mean, as I said in that graph I was showing before, and you know, during the 2008 crisis, you know, we got to something like 80, etc. So I mean, it's not as high as it could be, but we've climbed from these levels. We were at 19, so we climbed a bit, and it's elevated, but it's certainly not as elevated as we were back here in June at 33, or back here in March, which was 35 or 6, etc. Okay, so we've got a way to go, which means that there's plenty of room to the upside, and we can certainly climb that slope. Now, so I showed you all that, and just again insisting on technicals here, but because when this happens, it's very good to remind us that there is a connection between technicals and actual price moves. I mentioned on Monday that we have this, just make this a bit wider. I mentioned on Monday that we have this, I'm just going to make this a little bit, there we go, CCI divergence, and this happened in a period of 7th of September to the just basically 13th of September, which would have been the Tuesday. Okay, the Tuesday of the CPI. As you can see, the move here was quite great through the day, sustained, came through that candle, which would have incorporated the CPI, and stopped at 2, which is half an hour before the US market open. So it already moved quite a bit before the US market open. Then the market open for the US came through this candle and pushed the price lower, and then a third candle to finish the day, 6 till 10 p.m. UK time. So great move, 3 straight candles on the 4-hourly. But what's really significant is when I mentioned this on the Monday video, so that was before the CPI, that there was a divergence, and it started when we had this move up to so end of the previous week and the start of this week, and this divergence was basically sustained through a number of days. And I said that sometimes these divergences work, sometimes they don't, but when they do work, then you see price, you know, what comes first, the chicken or the egg, whether it's price conforming to the divergence or whatever. But essentially the two align, let's put it like that, and then you see this big drop in both, and now they're moving together again, which means that, as you can see, we're quite low, and we just dipped higher here just at the end of the day, but we could dip lower. When you're in a downtrending kind of situation, you can keep moving lower, or so testing the bottom if you like, and that can happen for a while. In fact, I put in a sort of cycle, if you remember, on the CCI a few videos ago, the daily CCI, just to show this kind of cyclical pattern or harmonic patterns on the CCI indicator itself. But I've taken it off, but that was just a way to demonstrate that there's a structure to trending through an indicator like CCI. That's basically it for today. I was going to show you one more thing, which is that we have, I'm just going to go to this open interest heat map. I had it all set up and then my audio started playing up, so I had to restart. So I think I have to just get it back on. Select products. Again, if you're new to this, you haven't used it before, all you have to do is go to the product that interests you. So for this, obviously, is going to be equity indices or indexes. I prefer indices myself, and that's the E-mini S&P 500. So the options based on the S&P, I'm going to select open interest change, because that sort of is, rather than the absolute number, is the change that we're interested in. The greener, the more contracts; the redder, the less contracts. And so we're looking for green as a measure of, so it's not buying or selling. Essentially, the red is basically less, and the green is added contracts. So the stronger the color, it's quite intuitive. The stronger the color, the more contracts are being added. Now, I was looking at this to prepare the video before, and I noticed that, so we are at 3.8, kind of roughly 3.840, let's say, today. So we're here, and around these sort of prices, the ESZ, these are the December expiry contracts, and then here is March 2023. So I'm not specialized in options, so I couldn't tell you why it's split into two columns, but let's just say that these two are essentially for December. So the Septembers have basically been taken off there because they expire basically start of next week. So that's it, finished. And what's really interesting is that we have the change. The biggest change is not in the prices above, as you can see. That's 211 calls at 3975, which is kind of heading back to the 4,000, which we've broken through. So the prices immediately above and below are not particularly strong. I mean, yes, we have 211 calls, open interest change to the positive there. But what's really interesting, if I go, so just bear in mind we're about 3840 roughly. If I go lower, okay, so again we're in the 200s for 3690 calls. Puts are not really present until this is where it gets really interesting for me. This massive change happens on the puts here at 1053. Yep, that's the open interest change. to the positive. So added contracts change, percentage change, 1053. So you can compare that to 200 that we saw earlier, so 5 times that. And that's happening at 3430, and that's puts. So a put option is the right, but not the obligation, to sell at a particular price. So 3430. Now, as I said, the 3000 level as a projection based on the 2008 moves is quite a way down, and 3430 is kind of halfway between where we are now and there, because we're kind of 3800, let's say, and then it's 3000. So it's a halfway step to there, which is still pretty big, and so there's a lot of puts there. So I think that, to me, says that somebody somewhere, a number of participants, are sort of predicting as an insurance policy, I'm going to basically purchase or basically invest in some puts at that level, 3430, and try to sort of hedge my bets. And so if price drops like a stone, essentially what that is telling me is that there's an expectation that there might be an event based on maybe previous bear markets, general movements, the fact that September is historically a month that where the S&P, intended as a sort of long-only portfolio structure, performs badly, i.e. moves down. Now, if you're shorting that or putting puts on, that's fine. You know, make money out of a move down. But essentially, it's telling me that that's an insurance policy. People are possibly expecting September to be a down month. Rates are going up with the Fed. Basically the money supply is shrinking through bond purchases by the mortgage-backed securities by the Fed. So that means that essentially the liquidity line is being cut. So all these things, there's an expectation that the price will continue to drop. Now, how far, we don't know, but this is quite a bit further down than we are at the moment. So another thing that I was going to show you was the commitment of traders from Barchart. And this is free information out there, absolutely free. And all you have to do is just, you can either look at CFTCs. So if you went to the CFTC commitment of traders, and this would take you to the commitment of traders. Okay, so the Commodity Futures Trading Commission have all the details for this, and you can see the commitment of traders there, and the reports are there. So types of reports, short and long format of reports, etc. Disaggregated data, October 20th. The current one is here. So you're looking for the financials, financial futures report, long format, etc. Traders in financial futures, futures and options combined, etc., etc. So and then you click on that, and this is it. Now, if you're not familiar with the format, it's not very sexy. It really is sort of old school. This could have come out of an old fax machine from the 80s, and I mean the font and everything is not very user friendly to read, but you can see all the data there. So you got let's say the top one there is the Canadian dollar. So here's the FX pairs essentially, and then after the FX pairs, if you scroll further down, you've got E-mini S&P, so Dow Jones, here's the S&P, right? Consolidated, Chicago Mercantile Exchange. And you've got on the first column there, it's the dealer intermediary. So the dealers tend to obviously sell to the long side. So the short or the sell side are selling to. So what you see is a perfect mirror image on the chart, which I'll show you in a minute. It's there. You can see the reds are the dealer intermediary, and they tend to move opposite to the long side, essentially, the buy side. Not buy because they're buying because they're purchasing a product, if you like. So, and then you've got the asset manager institutional. Asset manager institutional will be, here are your colors explained. Asset manager institutional, as your green there, here. Okay, so I'm using the disaggregated results down here, the 4 categories, rather than this one here, it's this one here. So deal integrity asset manager is in the green, and we've got your leverage funds, which would be in the blue, leverage funds, and the other reportables in orange will be here, other reportables. Non-reportables are again another category, but I don't really look at them, so just ignore that. Okay, so and then you've got change, so the change, how much is change, etc., etc. So you can check the data if you want, but this is the data for the Tuesday. So what happens is on the Friday, today is the Friday, you get the data for the Tuesday that's just been. So it's a lagging indicator, if you like. But if you look at the blue, which is the leverage funds, they are -525. If you go to here, the blues, the leverage funds are here. Okay, so open interest, etc., and then you have the change. Okay, now interpreting this is tricky. I'll key you not. So when you have it in chart form, it's much easier to see back in time. So this goes back to 3 years, but I'm going to just have it as 6 months because I don't need to see that. And then, of course, you could sort of stretch it back to 2008. In fact, that'd be interesting to do. So 2008 is obviously 14 years. So see how far we can go back on this. 20 years. Okay. So that's the pandemic there. 2008 is here. So I'm getting to know my bear markets quite well, as you can see, just by the shape of them. And now it's quite tricky to see, obviously, but there's the blues, the leverage funds, for example. In 2008, where were they? You can see the dates. Go back up a bit. That's better. Okay, 2008, June, July. So start of 2008. We are down here. And as we start turning down, they're buying. They're buying and adding to basically net long positions by September. But as I told you before, there's big moves in September, October 08. Price coming down quite a lot, and they're still buying and going flat. And then they start selling as we start climbing. So what that tells us is that leverage funds are not necessarily they may be trying to time the market. They're not necessarily sort of smarter than in timing the market, not in other decisions or managing risk, but timing the market can be tricky for everyone. And so that was 2008. When you look at 2020, the pandemic crash, we have probably a better view by making this just a 5-year, we'll see. It'll be a bit easier to see. Let me just restrict that view. But 5-year. And there's your pandemic there. So your leverage funds are kind of sort of buying at the point of the crash and then going shorter as this starts climbing. They haven't quite committed yet. And then I'm going to make it even more obvious to everybody by making this just 6 months, as I said. Now we can see more recent price action. So since the June lows, actually I think it might be, if I make it a year, might be better, probably. A year might be better. There we go. Okay, so let's go back up. Sorry about the slight messiness of this presentation. I was trying to sort of come up with ideas as I was presenting this as how to make the argument, you know, for various things. Anyway, so we're in January, just where I'm pointing there. Okay, that's January. Just the start of this year. So you can see the blue line there. Leverage funds are going higher, and they start going short after March. They're sort of net short in March. That's the big move. We have this first kind of rally, and they start going higher a little bit, adding positions to the long side, or taking short positions off, if you like. And then we have this further move there in June, and then new lows. Now, interestingly, as we start seeing this bear market rally, what is happening to the leverage funds S&P positioning? It's going shorter and shorter and shorter through that rally. And just recently, this past week, we've had a dip lower again. You can see the commercials there in the red, going higher. Now, the asset managers, institutional, green line, they've been sort of flat through that period, or slightly net positive. And the result of that is they're not aligned. The leverage funds and the asset manager, institutional, they're not aligned. Okay. So there's a real difference there. There's a real difference between those two. And this is particularly surprising that we had this decline through that market rally. But that's what we've seen. So I would sort of like to finish my presentation there by saying that next week, as I mentioned, is going to be the FOMC rate decision, which will happen in the evening for us here in the UK. So 7:30, we're going to see a lot of price movement potentially. This could be a catalyst. Now, the price expectation is obviously 75 basis points hike. So if you listen to John-Kicklighter on DailyFX, he usually has a table the day before, a table of probabilities, on kind of scenarios. His kind of probabilities and scenarios for price movements based on different outcomes from the Fed rate decision, the market's probabilities and outcomes, what's bullish and bearish. So, for example, he might say, or we might say 75 basis points is currently sort of neutral, or could be slightly bearish. 100 basis points would be extremely bearish or very bearish, and 50 would be bullish, because it would basically be contra or contradictory to everything that the Fed has been saying. So these kind of tables gives different scenarios for price for an index like the S&P, but also for other ones like the Dow Jones, the Nasdaq, the Russell 2000. So essentially US-based indices, but not only, but definitely those. And then you've got scenarios for the dollar as well, DXY. The dollar index is a basket of currencies weighted for the majority to Euro USD. And so it stands to reason that as the dollar has been appreciating a lot because of rate hikes and that sort of yield differential, it would go without saying that 100 basis points would favor the dollar even more against the yuan, Chinese yuan, CNH, against the euro. Again, the pound is sort of today went sort of under 114, which hasn't been seen since the 80s. So, that could continue lower. So dollar yen continues higher as well. And there's another thing as well, which I was going to mention before, and that was on the yield curve, which I nearly forgot about, but I should really put that in there. The yield curve, does the yield curve really forecast recession? So this is the St. Louis Federal Reserve Bank of St. Louis, and they've got the economic research area of their website, and they have this handy chart. So you might have heard about the 10-2 or 2-10 spread. I'm sort of quite new to some of these sort of area of economics and finance, so for me it was kind of a new thing to look at. So when we're looking at long-term trends, etc., it's good to know not to trade them necessarily or to invest through them, but as a more day trader, even then, to know where the trend is going or might be going, it's good to have an idea of the direction of travel ahead of us. So if we looked at this, this is the 10-1, 10 year to 1 year and you can see that so these are bonds, or actually treasuries, 10-year treasuries and 1-year treasuries, so government bonds essentially. And you can see that so basically when the 1 year appreciates and the 10-year appreciates, everything's good. If the 10-year minus the 1 year is negative, it means that it's a sign of a recession. Now, you can see from this graph that we have in the shaded areas the kind of downturns in the economy, and the last one in 2008 was basically forecast by the spread, which sort of came negative. There's a zero line there, came negative below zero before that recession. And then you got the real consumption per capita growth, and you know that sort of dropped as well before the recession. Okay, but what's really interesting is they also publish the actual chart. So if I stretch that, so this is where we're now. This is actually the 10-year treasury maturity minus the 2-year treasury maturity. So if I stretch that to there, now you can see a lot there since the 90s. I just need a bit less actually to 2000, just the kind of the last 3 recessions or downturns in the economy. Now, what is interesting about that is that they all seem to date about a year roughly before there's an actual recession. Now, we know that a recessionary environment, it's, you know, having a downturn is not the same. There's this sort of Main Street versus Wall Street. It's not the same to say that, so if you hear negative news about the economy, you know, about people being affected by inflation, etc., until the Federal Reserve Bank intervened into cutting the money supply, raising rates, making essentially holding risk more expensive, Wall Street wasn't maybe as concerned about its profit margins. So Main Street and Wall Street don't think the same. You might hear, you know, reports of the economy struggling, etc., but when you have the federal bank behind a change in TAC, that's where the market will listen. But sometimes, you know, a recession is also bad for Wall Street. So it's not impossible to associate those two things, you know, things being bad for the economy, so the fiscal side of things and the monetary side of things, and the stocks kind of being aligned. So let's just generally say a recession is bad for the stock market when it really bites hard, because, you know, companies will struggle as well. There's supply issues, there's profit issues, there's, you know, that has a repercussion. It's not enough to have a buoyant market when large companies behind it are struggling, and growth, consumption from consumers is struggling massively. So these shaded areas obviously are the recessions, and what you see is that the recessions happen, but the yield spread is actually rising, so it's contra. But what's happened before is that, so here's the 2008 financial crisis. Sorry, no, that's 2000, beg your pardon, 2001. So we are basically March 2001, this kind of shaded area, and the dip below zero happened. There was a little kind of warning sign there in 98, but it really happened here. Okay, February 2000 and March 2000. So almost exactly a year ahead of what would be a downturn in the economy there. Then the same applies to the 2008, the next sort of big financial crisis. This is a bit more interesting to me because this low here was, again, a year before, January 2007 roughly, but we first dipped below the zero line in February 2006. So it was almost like a 2-year warning that things weren't so great. But we revisited these levels a year before. So kind of roughly a year before is a warning sign. But then it could have happened before 2008 if this first one were to be the one that we should judge recessions by, or warnings of recessions. And then the other thing is that it's the levels that's also interesting, because the zero line is bad enough, but if we dip below, this was 0.40 negative, and this second one was 0.60 negative, but the one preceding the 2001 recession, that was 0.47. And where we're now, this is why I wanted to get to today, where we're now is, oopsie, did something really bad there. I unfortunately have lost that. Apologies. I had to just find that again. All is well. All is well. What level are we at today? Well, we are at negative 0.40, which is very similar to where we're at here in the 2001, the year before that downturn. So we just plunged below zero, and that happened just in May, June, July. So this month we're at 0.40 negative. And we've not had the sort of shaded area for a recession, because technically speaking, we've been told that we're not yet in a confirmed recession in the US. So, but the Fed are not going for the soft landing, they're not pivoting, they are, if need be, going to hike rates and cut, with QT, cut liquidity, into a recession. So, they want to fight inflation, which should benefit stability for the economy and for employment. So, but the yield spread has a predictive nature, as you can see. It's not perfect, but it's been talked about in circles because it's clearly going to hasten some kind of downturn, and that is a concern. And we can only just kind of try to be good as traders and be prepared. Obviously not long-term investors have a different challenge on their hands. We're more nimble, but certainly being aware of trends and trading in the direction of the trend is also important. So kind of knowing that we are safer trading in the direction of, say, a downtrend in this case, and then the uptrend will come back when it will come back, and we'll have a different way of looking at positioning, entries and exits, and the CCI, how it will work in an uptrend will be different. So thank you very much for listening. It's a lot to take in a note, but I hope you find this interesting. There's a lot going on this week, next week, and I look forward to seeing you in my next video. Have a great weekend, and I will see you very soon. Take care.